When a central bank announces a decrease in its official policy rate, the desired impact is an increase in, and we have three choices. The answer is A. I'm just going to get to that right away. However, if we didn't know that the answer was A, if we read A and said investment, and we said, well, I don't know, could we eliminate the other two? You don't have to know that A is the answer for this type of question. You just have to know that it cannot be B and it cannot be C. So we have a decrease in the official policy rate leads to an increase in interbank borrowing rates. If the official policy rate is decreasing, interbank borrowing rates are also decreasing as well. We can get rid of that because we're looking for an increase in something. The national currency's value in exchange for other currencies. Well, we know that when rates are going up, it puts upward pressure on the exchange rate. When rates are going down, it puts downward pressure on the exchange rate. We're looking for an increase in something. You can get rid of that. It's got to be investment. And since you get to that, you can just think it through. Well, if you have a lower interest rate, are companies more or less willing to invest? Remember, companies have a capital structure, a certain amount of debt and a certain amount of equity. So when they make an investment, there is a certain amount of debt and a certain amount of equity involved. Well, the cheaper debt is, that means if they're looking at all their cash flows, right, and they're discounting it by the weighted average cost of capital, if debt is cheaper, that means equity is cheaper because the cost of equity is the risk-free rate plus some risk premiums, whatever risk premiums you add on to that. Well, that will increase the present value of all those cash flows, which will increase the desirability of projects, which will increase investment. Which action is a central bank least likely to take? Keep in mind the direction here, least likely. If it wants to encourage businesses and households to borrow for investment and consumption. Well, if you're trying to encourage borrowing, you would like to have lower rates rather than higher rates. So we're going to look for the answer that leads to higher rates because we're looking for least likely. Sell long-dated government securities. Well, if we're selling long-dated government securities, it is going to push the price down. And remember, there's an inverse relationship between price and yield, which means it pushes the yield up. The yield is the rate or the cost of borrowing at that tenor. So it would increase rates on long-dated tenors. We wouldn't want to do that. But we're looking for least likely. We know we wouldn't want to do that, but maybe something is even more least likely, right? Purchase long-dated government securities. Well, these are opposite. If we know that they don't want to do that, well, then the opposite is something they would do. So we can eliminate B because we're looking for least likely. Purchase mortgage bonds or other securities. Well, that is going to have the same effect as purchasing long-dated government treasuries. So they wouldn't want to do that because we're looking for least likely. They would not want to do anything that increases rates, and that would be A. A central bank's repeated open market purchases of government bonds. Well, what's it doing when it buys government bonds? Here's a holder of the government bond. Here's the central bank. The bond comes over here. What goes over here? Money. And this is the economic system over here, and this is one of the participants in the economic system. You're putting money into the system. Decreases the money supply. No, we just said we're putting money into the system. Is prohibited in most countries. We did not come across anything that says it is prohibited in most countries. It may be difficult in some countries because they have a small or illiquid government bond market. That's not prohibited. Is consistent with an expansionary monetary policy. Yes, if you increase we'll just call it M2, the money supply. If you increase the money supply in an economy, it is expansionary. That is consistent. A prolonged period of an official interest rate very close to zero without an increase in economic activity most likely suggests. So let's draw that out. You've got rates pretty close to zero, so all your money market rates will be fairly low. You'll have a jump to the 2-year from the 1-year to the 2-year for your capital market rates, and the rest of the curve will look like this. Quantitative easing must be limited to be successful. Well, quantitative easing will target the 5-year or the 10-year tenors to try to lower the curve to stimulate more borrowing. And if we have economic activity, no increase in economic activity when you're already very close to zero, quantitative easing must be limited? No, it must be unlimited. You must have as much of it as you possibly can. We can get rid of that. The effectiveness of monetary policy may be limited. That is true. If you've gotten your policy rate all the way to zero and it's still not doing very much, so you do have some limitation in your monetary policy. Targeting reserve levels is more important than targeting interest rates. Well, if interest rates are already super low and it's not forming any new kind of credit creation, because credit creation is the driver of economic growth. If it's not creating or leading to credit creation, then changing the reserve level so that banks can actually lend more isn't going to do anything, because they're not lending right now. Either there's no demand for credit or banks just are unwilling to lend. Giving them more money to lend isn't going to help, so we can get rid of that. B. Raising the reserve requirement is most likely an example of which type of monetary policy? Well, we're raising the reserve requirement. It's going to do something so we can get rid of neutral. We just have to figure out if it's expansionary or contractionary. So let's say the reserve requirement is 5%. 1 divided by 0.05 equals 20. That means $1 into the banking system in deposits will create $20 in loans. Let's raise the reserve requirement to 10%. 1 over 0.1 equals 10. That means $1 into the banking system will create $10 in loans. Well, which one is more expansionary? Which one will create more demand? Obviously the 20 versus the 10. So if we're raising the reserve requirement, what are we doing? We are lowering the amount of credit growth in the economy. That would be contractionary. There we are. Which of the following is a limitation on the ability of central banks to stimulate growth in periods of deflation? Ricardian equivalence. This deals with fiscal policy. The anticipation that higher spending today leads to higher tax rates in the future, so consumers cut back in their spending by the amount that governments increase their spending, thereby making spending sort of useless. Interaction of monetary and fiscal policy. Well, we're not told what type of interaction, so you can't go anywhere from there. And we're looking for a limitation to stimulate the economy in periods of deflation. This gives us no information. Interest rates cannot fall significantly below zero. We have this saying that rates are bounded by the zero line, or bounded below by the zero line. We have seen negative interest rates, but that is what you have to do, is take interest rates negative. So there you go. See? The least likely limitation to the effectiveness of monetary policy is that central banks cannot, A, accurately determine the neutral rate of interest. Well, that is true. If you ever heard of the term R star, that is the neutral rate of interest. And that can either be a real or a nominal rate of interest. But that is the rate at which it would neither increase nor decrease inflationary pressures. And that is really an estimate. Almost all central banks have that as an estimate, but that does not change the effectiveness of monetary policy. If inflation is too high, you raise interest rates. What does it matter if you know exactly what R star is? So not knowing the neutral rate would not limit the effectiveness of monetary policy. We're looking for least likely. That is an answer, but there may be something more least likely, right? Banks cannot regulate the willingness of financial institutions to lend. That is true. Even if you pump money into the system, banks may hold it, creating a liquidity trap. Well, that would limit the effectiveness of monetary policy. This is more likely, so we can get rid of that because we're looking for least likely. Let's see, central banks cannot control amounts that economic agents deposit into banks. Well, that is true as well. Remember, without a deposit, you cannot have a loan, right? There's your liabilities, there's your assets. So if $10 comes in, $1 in reserve requirements, the bank can lend out $9. Well, if you buy government bonds from individuals and they have money, there's no guarantee they're going to deposit that money into the banking system. So this is a limitation to the effectiveness of monetary policy as well. That is more likely, not least likely. It would be A. It does not matter if you know what your neutral level is. You know the direction. Higher rates, lower aggregate demand. That's the mechanism. And that could be just as effective knowing the neutral rate as not knowing the neutral rate. Quantitative easing, the purchase of government or private securities by the central banks from individuals or institutions, is an example of which monetary policy stance? Well, we're actually doing something. We're buying something, so we can't say it's neutral. You can get rid of that. It's either expansionary or contractionary, and the answer is in the title, easing. It's easy monetary policy. Easy monetary policy is expansionary.